moving a little bit beyond rates and thinking about, given this uncertainty, risk across different asset classes, where do you see the most opportunity for the year ahead?
I suppose diversification remains key, as I've said a couple times, and we'd always drive that point home. Flexible strategies can also take advantage of a more uncertain yield and spread environment. We would drive that point home. We continue to find, reasonable opportunity in both public and private credit markets. Here, I would emphasize, as I mentioned, the generic credit spreads don't look all that attractive, but certainly there are opportunities in public markets through sort of the COVID recovery theme that can be embedded in industries like airlines, lodging, retail, other real estate related sectors that should benefit quite strongly from the reopening of the economy and have lagged the recovery in terms of financial markets. Speaking of real estate more broadly and perhaps more specifically, we find great value in non-agency mortgages today. We had found great value in the agency mortgage-backed securities market, which offered very compelling valuation this time last year, less so today. And so we look more to add value through the non-agency mortgage sector than the agency mortgage sector. High quality emerging markets, if we do enter a period of strong global recovery with ample central bank liquidity and perhaps a kinder, gentler geopolitical environment, that should be an environment where emerging markets should be able to find their footing. More broadly, as we think about asset allocation, we think the convexity of equities look quite good in terms of a strong recovery, in terms of the early nature of a cyclical recovery, similar with the COVID recovery theme in corporate credit, both public and private. When we look at the equity markets, we would favor cyclicals over defensive, and that's been a theme that's worked and should continue to work. And then lastly, we've talked about fiscal policy and infrastructure and another fiscal package that will likely create a longer-term spending profile, which will probably be paid for, which means taxes are going up, and therefore, at least in the United States, municipal bonds look quite good to us. So there are sort of some specific ideas, Tina, in terms of where we're seeing value over the next 12 months.